Let's talk about investing. For a lot of us, that word alone can bring up this feeling of, well, anxiety. It can feel like you need to be some kind of Wall Street genius just to have a chance. The whole financial world just seems intentionally complicated, almost designed to intimidate you. And you know what? According to author J.L. Collins, that complexity isn't an accident. It's a business model. See, when investing is made to seem really complicated, it becomes way more profitable for the financial industry and, of course, more expensive for the average person like you and me. It pretty much forces us right into their waiting arms.
But what if that's all a smokescreen? What if the secret to building real, lasting wealth isn't more complexity, more research, or more stress? What if the most powerful path is actually one of radical simplicity?
So, what is this simple path? Well, it's built on a formula that's so straightforward, its true power is often completely overlooked. Okay, here it is. 3 simple rules. That's it. Number 1, spend less than you earn. Number 2, invest the surplus. And number 3, avoid debt. Seriously, that's the whole foundation. This isn't just some financial trick, it's a framework for your life. And that third one, avoiding debt, it's absolutely crucial. Every single dollar you're not paying in interest is another dollar you can put to work for you. And you have to remember, the ultimate goal of this simple formula isn't just about piling up money. It's about buying the one thing money can get you that truly matters, your freedom. The freedom to make choices based on what you value, not what your bank account dictates. Okay, so the formula is simple. Got it. But what about the tools? Surely this is where all the complexity comes in, right? We're talking dozens of stocks, bonds, international funds. Well, not exactly. In fact, this approach suggests you don't need a complicated portfolio at all. For most of your investing life, you might only need a single, incredibly powerful tool. The logic is actually pretty brilliant. Instead of trying to find the needle in the haystack by picking winning companies, why not just buy the whole haystack? That's the core idea of an index fund, a single investment that buys and holds the entire market, harnessing all of its collective power and growth. And that tool, that haystack, has a name. VTSAX, Vanguard's Total Stock Market Index Fund. The easiest way to think about it is like a single shopping basket that holds a tiny piece of thousands of US companies, from the biggest names you know to the small innovators you've never even heard of. So, why does this one fund approach work so well? Well, for one, you're tying your financial future to the entire US economy, not just one company. It's also self-cleansing. As winning companies grow, they just naturally become a bigger piece of the fund, while the failing companies shrink and fade away, all without you lifting a finger. Plus, the fees are microscopic, so more of your money is actually working for you. And here's the kicker. This simple automated approach has historically beaten the vast majority of professional stock pickers over the long run. Okay, so the strategy is simple, and the tool is simple. But there's always a but, right? Here's the catch. The hardest part isn't the what or the how. It's the psychology. It's about mastering your own mind when things inevitably get turbulent. I mean, just look at this chart. It tells the whole story. In the short term, the ride is absolutely wild. You can see these terrifying drops, these long flat periods where nothing seems to happen. But the long-term trend, it's relentlessly, undeniably up. The entire challenge is just having the discipline to ignore all those bumps and stay on for the ride. So here's the absolute truth of it. Your greatest enemies as an investor aren't a bad economy or a market crash. They're your own emotions. Fear during a crash that makes you want to sell low, and greed during a boom that makes you want to buy high. Your greatest allies? They're much quieter. Time and discipline. The patience to let your money grow and the strength to just ignore all the noise. And hey, don't just take it from me. Even Warren Buffett says it. People don't lose money because the market goes down. They lose money because they try to outsmart it, dancing in and out at precisely the wrong times. Simplicity is your shield against that self-destructive impulse. This next part is a mental shift you absolutely have to make. Market crashes are not a sign that something is broken. They are a feature, not a bug. They are a normal, predictable, and even necessary part of building wealth over the long term. You have to expect them, you have to endure them, and if you do, you will be rewarded. So, when you combine this simple strategy with that disciplined mindset, what's the actual payoff? Well, it's powered by one of the most incredible forces in all of finance. And that force is compounding. It's the magic that happens when your money starts earning money, and then that new money starts earning even more money.
It's like a tiny snowball rolling downhill. It starts slow, almost unnoticeable, but over time it grows into an unstoppable avalanche of wealth. Let's make this real. To see this in action, let's look at an actual 40-year period, a time filled with recessions, crashes, booms, the whole shebang. Imagine you invested just $10,000 into the US stock market back in 1975, and then you did the hardest thing of all. You didn't touch it.
So what happened? By 2015, that single one-time investment of $10,000 would have grown to nearly $900,000. That's not a typo. That's the raw power of time and compounding. You didn't have to predict a single thing, you just had to participate and be patient. And this chart, this just drives the point home perfectly. See that tiny little sliver on the left? That was your contribution, 10 grand. That giant bar next to it, that's all market growth. It's a visual reminder that the real heavy lifting in your portfolio is done by compounding, not just by how much you can save. Which brings us to the core takeaway of this entire explainer. Wealth isn't built by being a genius market timer or a brilliant stock picker. It is built through the simple, disciplined act of consistently owning a piece of the market over a very long period of time. So look, the path itself is astonishingly simple. It's laid out right in front of you. It doesn't require any special knowledge, and it takes very little effort. But it does demand one thing, the mental toughness to stay the course when every ounce of fear in your body is screaming at you to run. The path is clear. The only question left is, are you tough enough to walk it?